Hello, everybody. Welcome to my Intermediate Accounting 17th edition video solution walkthrough for Kiesel, Weingen, and Warfield. This is exercise 1514. Okay, so right over here, we've got entries for stock dividends and stock splits. So we've got the stockholders' equity accounts of GK Chesteron Company had the following balances on December 31st. Okay, so we've got common stock, shares issued. Shares issued. Shares outstanding, APIC, common stock, at par, and then retained earnings. Okay. Okay, so this right over here is at 300,000 shares issued. Common stock at par is going to be at 3 million. This is going to be 1.2 million. And then my retained earnings is going to be at 5.6 million. My company stock is presently trading on the Midwest Stock Exchange at 37. Okay. So the stock dividend of 5% is declared and issued. So usually what you would do is you would have a date of record, date of declaration, and whatever may have you. So let's just go ahead and do letter A. So for letter A, if the stock dividend is below 25%, this is considered to be a small stock dividend. The way we do that is we're going to record it at market value. So what I'm going to first need to go through and do is to figure out our shares outstanding, which is going to be at 300,000 shares outstanding. My stock dividend percentage is at 5%. So my total shares to issue under the stock dividend is going to be 15,000. The amount of my stock dividend on declaration. So I'm going to do 15,000 at 37. So when I declare this 5% stock dividend, I'm going to go ahead and do it at, this is going to be 15,000 shares to be issued at $37 per share. Okay. I credit common stock dividend distributable. Okay, this is going to be my common stock par value times the total amount of shares to be issued. Okay, so my common stock par is at $10 per share. Okay, so my next one over here is going to be additional paid-in capital common stock, 405,000, which is essentially going to be the difference between 555 and 150. Okay, now when the dividend is actually distributed, what I would be doing here is I'd be debiting common stock dividend distributable, and then I'd be crediting common stock at par. So when we declare it, we got to record the amount of the dividend. This would eventually be going to retained earnings. So if we looked at situation A, my shares issued would be increasing by 15,000. My shares outstanding would be increasing by 15,000. My common stock at par is going to increase by 150,000. My additional paid-in capital common stock is going to be increasing by 405. But what's going to happen is that this stock dividend is going to be what happens to the dividend. Well, my dividend is going to be on my books. So I've got a stock dividend of 555,000. When I go to close my financial statements, right, dividends, revenue, expenses, I'm going to have to close this out to retained earnings. To make stock dividends go to zero, I'm going to have to credit stock dividends. I'm going to go ahead and debit retained earnings. So this over here is going to have the effect of taking us down, right? So right over here, you're effectively decreasing your amount of retained earnings. So that's how this part of this over here goes through and works. Okay, so if you've watched my last video, you're going to see now why I get upset at this next part. So we're declaring 100% stock dividend. Okay, so my shares outstanding are going to be 300,000. When I do 100% stock dividend, right, my total shares to be issued are going to be at 300,000 shares. When I have a large stock dividend, okay, when I have a large stock dividend, what's going to happen is I'm going to basically record it at par. So the way this is going to work is I'm going to have stock dividend, common stock dividend distributable. But in this case here, I'm only going to report it at par. So this is going to be 300,000 times the $10 par value. Okay, so this is what's happening over here. Then I've got common stock dividend distributable, and then I've got common stock at par. Okay, so right over here, this is going to be, again, 3 million and then 3 million. So when I have a large stock dividend, this is what is going to happen. Now, what would happen to this over here? Well, my shares issued are literally going to double. Shares outstanding are going to double. My common stock at par is going to double. My additional paid in capital common stock is going to remain the same. But artificially, my retained earnings, because what happens with a stock dividend is going to be the same thing over here. This is going to effectively be decreased by 3 million. Okay, so, and if I add up these three accounts, what you're going to notice is all I'm really doing is I'm shifting things around. I'm like what is it, the 3-card Monty? Or the basically, what is the confidence game trick, right? So I'm like, it's like, this is like accounting 3-card Monty. This is like accounting after dark. All I'm doing is I'm manipulating my existing accounts. And I can tell you, a publicly traded company, what's wrong with this picture. Here's the first problem. You've got a $10 par value per share, right? You're essentially, Wiley would be accused of legal malpractice. So there you go. Okay, so that's this part over here. Now, if the par value, what if the par value is 0.0001? Okay, so how would that differ here? Well, if I looked at my initial situation, right, gym, tanning, and laundry, my common stock at par would effectively be would be $30, right? So now you look at the additional paid in capital common stock. This would be now 4.2 million minus 30. And then you'd have retained earnings. So we're at the same number, right? So all I'm doing here is I'm basically saying, well, what if the par value is now 0.0001, right? That's what I'm doing right over here. So if I did a stock dividend in this situation, okay, and again, this would never work for a publicly traded company. 100% stock dividend is going to have the same effect. But look at what's going to happen now. Well, what I'm effectively doing is that I'm going to have my stock dividend is going to be 300,000 times 0.0001 or $30. And then over here, I've got the $30 over here. So my common stock at par is going to be here. There's no effect here. Retained earnings just went down by $30. And if I look at this, so my common, so basically my total amount is now still at 9.8 million. So effectively, by going through and doing, if I have a par value, my common stock, my stock dividend really didn't have that much of an effect. Again, if you've heard me say in the other videos, they would never, an exchange would never allow this to happen, because it's essentially you're manipulating. They would be saying, wait a second, why aren't you doing the right thing, which is doing a 2-for-1 stock split is declared and issued. So the last part over here, if we have a stock split, right, what exactly is going to happen here? So if I have a 2-for-1 stock split, this is going to increase by 2. My common stock at par, the par value is going to remain the same. But if I were to expand this out a little bit, okay, this would now be at, hold on. So my common stock at par is really going to be my shares outstanding times the par per share. So my common stock at par is going to still be at this amount, and it's just with a 2-for-1 split. That's effectively what this is doing. So again, there's going to be no journal entry. What we're going to be doing is we're going to be going ahead and adjusting the amount of issued, the amount of authorized, issued, and outstanding shares for the 2-for-1 stock split. So that's the different situations. Again, if I find out that you watch one of my videos and you decided to set a par value of $10 per share, just don't tell me about it. So anyways, have a great rest of your day. I want to thank Wiley. Please don't forget to like and subscribe. If you're looking for other solutions, please feel free to ask for them in the comments. Have a great one, and I look forward to seeing you on the next video. Wow, I'm getting that upset about par value. I just don't get it. Have a good day.